In this section, we're going to look at tracking your progress. By trading in sample sizes of 20 trades a set, we are able to monitor our progress to see how our method performs over the long term and shift our focus away from the trade-by-trade mentality of an amateur trader. So the important thing here to note is that we're going to monitor our trades and we're going to trade in sample sizes. Okay, not trade by trade, just randomly placing one trade off the other. We're actually going to track our performance over the long term. Our goal is to capture data on a daily basis. The more data we have, the more information we have at hand to assess the reliability of our edge. If our edge is diminishing, we don't want to lose our whole account before we realize something is wrong. Okay, so this is getting into tracking our progress. Capturing data, okay, is very, very important. So instead of taking a random approach, or even if you have a method, it's very important that you sit down and you capture the information, okay, to assess the reliability of your edge. By using a simple spreadsheet, we can keep track of how we're doing. Remember, this is a pure numbers game, a game of probability. So this comes back to our example with the casino, about showing you how a casino works and then trading it in sets. And now we're going to use the same structure in our trading to track our progress. So here's an example of a spreadsheet where we track our performance, and like I said, you can use any basic spreadsheet, but all you want to do is you want to be able to add in information along the way. And here again you can see the pair we've got on the left hand side. We've got our entry price, we've got the time frame the trade was taken on, whether it was a long or short entry, our initial target, the stop, our initial risk reward, and then what happened to the trade. Did it win, did it lose, did it break even, what was the gain? Was it a positive gain, or was it a loss? Was it a break even trade? And then the value of the account, okay, and then obviously your balance. And you can see I've highlighted this, and for the first 20 trades, okay, 1 through to 20, we've got a sum of 4.89%. Okay, so here again we're working percentage, we're not working in pips. You can add the pips up as well. You know, it depends how you want to track your progress, but on an industry standard, we deal with percentage, okay, not dollars and cents or pips. And then you can see over the longer term here, we've got a bit more information, and that's why I say it's very important to gather the information. So the more information you have, the more reliable you can assess your edge, or reliable the data is, so that you can assess your edge over the long term and not a trade by trade mentality. Okay, so very, very important. Let's talk a little bit about risk management. Now, we hear a lot about risk management, but do we really pay attention to it? Okay, and I'm going to show you why it's important to pay attention to risk management. And here again, I hope by looking at our example at the casino and also that previous spreadsheet, we can see why it's important, because we're going to see random distributions along the way. We don't know what's going to happen from one trade to the next. So, you know, you may go through a streak of 4 or 5, or 6, 7, 8, 9, 10 losers in a row. And if you trading big risk, it can be pretty dangerous. So controlling your risk is your number one focus if you want to survive in this game. Okay, I cannot stress this enough. It's really, really important. So how much should I risk on each trade I put on? This is a question we get asked quite a lot. And if you're new to this, maybe 50% of your account on a trade, maybe 30%. 30% is reasonable, isn't it? 25% maybe. You risk a quarter of your account on a trade. What about 10%? 5%? The industry standard or the textbook rule says 2%. Okay, now 2% in my view is far, far too high. 50% if you want to go bankrupt or blow your account out in 2 trades, that's not clever thinking at all. In terms of risk, when you're learning to trade, I would suggest not risking more than 0.1 to 0.25% a trade. Okay, so just read that again. 0.1, not 1%, 0.1% to 0.25% a trade. Okay, very, very important. The smaller the risk, okay, the longer you're going to be able to survive in this game until you can start becoming consistent. Okay, very, very important. If you can't make consistent gains on risking tiny amounts, and here again I'm talking cents, guys, okay, you will not do it risking more. It's as simple as that. It really is. So please read that again. If you can't make consistent gains on risking tiny amounts, and I'm talking cents, you will not do it risking more. Okay, I don't know why people think if they're risking $10 a pip or $20 a pip that they're going to make a fortune. Okay, if you cannot make consistent returns month in, month out by risking a few cents or 1 cent a pip, you're not going to do it bigger size. It's that simple, and that's what's so nice about this industry. You really don't have to go through a lot of money to learn the trade. Once and only once you're able to trade with confidence and not make mistakes should you even consider risking more. I suggest never ever risking more than 1% of your account size, and I mean ever. Okay, 1% is in my view is still too high, but I do understand you're trading retail accounts, and it's not about getting rich quickly, guys. Okay, remember, trading is a skill. As with any other profession, it takes years to master. Alright, the money will flow into your account, but only when you've developed the skills. This is very, very important. Okay, you're coming into an industry that's filled with professionals that have been doing this for years, decades. Okay, do not think you're going to step in front of the screen and start pulling out thousands and thousands of dollars a day. It's just not going to happen. So you need to have a reality check. Okay, step back. As with any professional industry out there, it takes a long time to learn the game. Okay, so look at it from a point of view that I need to learn the skills, okay, to become professional or proficient in what I'm doing. Okay, so if I want to become a doctor, I need to go and learn the skills involved to master that trade. Okay, this is no different. So please don't get confused or get caught in the hype emails or the hype internet scams out there. It's not a get rich quick way of doing things here. It's about learning the skills so that you can master those skills, so that the money will flow into your account when you've developed the skills.